I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market ended the week mixed to higher as investors piled into tech stocks and selective online retailers whose earnings greatly benefited from the stay-at-home economy. Also helping was another Fed meeting on Wednesday, as they said once again they will do as much as it takes for as long as it takes to hold up this economy. Bond market, well, they rallied on that news, and yields have gone down to another record low, as the Fed had already said on Tuesday that they were extending all the lending facilities through the end of the year, so their meeting they really did not say much at all. Economic news overall around the world was just horrible. The U.S. GDP fell on an annualized rate 32.9% for the second quarter, and that's over 3 times the worst ever numbers we've seen. That includes the Great Depression. Initial jobless claims, well, they edged up again to 1.43 million, and we have ongoing jobless numbers that are extremely high. The news was even worse in the EU as Q2 GDP came out for those 19 countries at 12.1%. That's not annualized. That's actually for the quarter, and if you annualize that, it's worse than the U.S. Spain actually for the quarter had a loss of their GDP of 18.5%. So this, no matter how any of these central banks want to spin it, this is the Great Depression number 2. Of course, it is different because we don't have food lines, but we have different ways that money is getting to the people, and I have no argument with that. My argument is the fact that we have a corporate welfare that goes way beyond anything that we should be seeing right now. I'll say a little bit more about that in a moment. Earnings reports, they poured out, and they were broadly mixed. And really positive where it mattered. The heavyweights in the NASDAQ, Apple, Facebook, Amazon, all big earnings beats as they benefited from people working from home and people using different entertainment vehicles to get them through the monotony. I really relate to that. And Apple also came out and said that they were going to split the stock 4-to-1, which is very uncommon these days, as these companies love to see their stocks get up over 1,000. And that's for holders of record on the 24th of August. And they will then have over 15 billion shares outstanding. And you think anything trades in a much more docile way when these happen? Well, Apple will prove that to you. It certainly will be trading like a utility afterwards, as that massive amount of outstanding shares trading at around $100 will be very, very difficult to move. So we'll see that probably will greatly affect the Dow also. As Dow is price weighted, so that will affect how much Apple can influence the Dow, of course. So all of these great earnings in the tech sector, Intel was an exception. They actually beat, but they had a chip delay, and that really helped Amazon. That went AMD, which really was soaring to the upside. Amazon, their analysts are out there. Many of them giving an upside target now of 4,000 plus and that has helped Amazon, but it's only up about 3% on the day. Apple, a much bigger gainer here on Friday, up over 6% on the day. And Google actually weaker as they reported earnings, and there is an ad slump going on. Now, Facebook sidestepped that, but I don't think they're going to be able to by that much going forward, as we do expect that these big upside bulges will be ending pretty soon. The old economy stocks, so we have this huge disparity going on. Those stocks, manufacturing, much different story. Energy stocks also, so it's kind of old economy, new economy. The old economy stocks that don't do so well in a stay-at-home depression, Triple M, Boeing, Exxon, CVX, all moving down very, very sharply on weaker earnings, really bad earnings, and that's weighed on the Dow, which underperformed this week. And talk about old economy companies, U.S. Steel, it was the worst of our 300 and something stocks that we look at, down about 14% on the week, as they are just bleeding money. So U.S. Steel, certainly an existential threat for that company. And other stocks in that category, Caterpillar beat, but the stock fell. It's an oddball, really, if you ask me, because they service mining companies. And their order backlog is down, and their sales plunged by 31%. So they should have really been doing better selling all the mining companies that are doing so well because of these higher gold and silver prices, but that has not been the case. This all makes it clear, this growing disparity and the narrowing number of stocks that are driving the stock market to the upside and driving those indexes compared to the overall broad market. Even the Fed's, corporate welfare is not helping, as it's creating huge income disparity between these companies. Some of them are doing really well in this economy, and others are not at all, as illustrated here in these earnings and movements. Now it's getting to the time that the government is getting stingier. The Fed is mostly jawboning. There's really not a whole lot they can do more. They say that they have tools, but all they can do now is buy stocks, which there's going to be a lot of pushback around that. And the government, they're not being able to put this deal together to extend the stimulus for the people, very, very far on there, as there are a few people out there in the government that are focusing on a healthier level of governance and less spending. In this world of $7-8 trillion balance sheets for the U.S. Fed and the other central banks around the world, the total of now about $15 or $16 trillion in funny money they printed. Well, I don't even understand the argument over a few hundred billion here or there, to tell you the truth, because they are so far out of whack here that I don't think that it really matters at all. So while these few stocks, these great stocks, are supporting the market, the Apples and the Amazons, what we've really had here is 2 weeks of thrashing. And I believe the upside is very, very limited now, and the correction is at hand. Here we see on Friday the market dealing with all of these very, very good earnings in the tech stocks, and Apple having this big gain, and the market moving to the downside as it could not hold those gains. So I think it's a strong likelihood that August into September is a sizable corrective period. We're going to call for a pretty good down period during that time. We have been. All of this good news in these stocks, it doesn't change that. And these insane analysts that are putting these wild targets on the upside, well, all they're doing is sucking in a lot of investors. For the week, the S&P 500 gains less than 1% right now. The NASDAQ up about 2%. We're also around unchanged, and the Dow down about 1%. So you can see it was a pretty mixed week. The bond market, the 30 years gains about a point. The 10-year yields fall about 4 basis points. And, clearly we're in ZIRP policy, zero interest rate policy, and in crisis mode. So, again, without all of these stuff, without the 20 or 30 or whatever it is stocks that have done well in the stay-at-home economy, the rest of it is just in horrible shape, and that's why the bond market is at these levels. That has certainly stimulated the gold market, which has hit our upside targets. Gold up about $70 on the week. Again, that was after previous week's gains. A new peak at 2005 intraday here today. Silver gains $1.20 on the week. That is looking toppy, and we have some reason to believe that the gold and silver market will be in a modest corrective period coming up here pretty soon. The dollar loses about 1.4%. We think a temporary bottom is being put in. I'll show you some revised short-term analysis as we get forward in the show. And the oil market loses about $1.50. It's kind of in a slow roll right now, going down as the overall economies are slowing in a very significant way, and that is putting some pressure on these prices in the oil market. So that's it for the opening of the show. I want you to go to askSlim.com, explore our website. I'll tell you a little bit more in a little bit about our specials, and subscribe to our website, or you can ask for a demo by clicking on the button in there, and share this video with everybody who's in the market. Make sure you follow us. Subscribe on the YouTube channel and click that notification bell, and then you'll know when our videos go out. And make sure you give us a thumbs up, like this video if you do like it. On Twitter, follow us at askSlim. And for membership info, which I'll give you a little bit more information, write Matt at askSlim.com. All right, so I want to tell you a little bit now about some massively overpriced stocks that I think are important to look at. And we're going to look at 6 stocks in here that I think are very, very subject to a decline in the market right now, and we're going to switch over to our charts. I'm going to go from this Apple chart that I have up here to the chart of the first one of the 6 that I'm going to show you is Lululemon, L-U-L-U. So here is Lululemon. Now, the 6 stocks I'm going to show you are stocks that I look through our 300 plus universe of stocks and looked for the stocks that I think are trading at exceptionally high values that just really don't make any sense for what I see here. They're very, very high PEs, and they are very overpriced. Now, note in here the 34-week moving average, and very, very often you get a decline towards that 34-week moving average as a stock corrects and gets too far. These are cycle brackets on the bottom. They help us see the rhythm in the market, and this points for about a month of decline along with what we're looking in the stock market. We're making a pretty bullish call and saying we think this stock is going to fall to about 278. That would be, about 45 points on the downside, we think, coming up in the next month. It could get all the way down here to 247 at that next support, and that is where that 34-week moving average comes in. Often you only test in very bullish conditions the 13-week moving average, but that would still take you down here to about 295. So we think the next month has a ton of risk in a very, very overpriced Lululemon. There's only so many of these yoga pants that you could sell for the people that are staying at home. This forward PE at 75 is outrageous in my opinion, and we think the stock has got a decent amount of downside risk. Now we're going to move forward in stocks that are just even more outrageous here. Forward PE on Now. This is ServiceNow Incorporated. They're in cloud computing, benefiting certainly from the stay-at-home economy. Stock trading at 430. We're looking for a dip down to 370 to 350 on the downside. And here, just extraordinarily overpriced when you look at Now. And I think that the movement is going to start now to the downside. We'll take a look now at Shopify, SHOP. Remember, these stocks are stocks that I deem as very, very overbought and extremely overvalued. There were big upgrades in here to the earnings forecasts. The forward PE still at 500 plus. The stock is $1,000 stock, and next year it might earn $1.65 or $1.70. This is totally outrageous. We're going to look for a break here down to under 800, a rally probably back up, and then some decline that probably cuts this stock in a third. So Shopify, we're looking for the next month to give you a significant move to the downside, down to about 800. Next one is TWLO. This is Twilio, and here's another crazy valuation in here. The stock had no earnings. Now they're projecting in 2021 it may earn 17 cents. There's no PE, of course. These are very, very strong patterns that we have in here. You can see when the declining phases say you're going to get a correction and you get minor little down tips. Those are called swamped cycles. You have one right over here, and you could get almost no decline in here, one little downtick for a week, and then starting to move up again. This is extraordinarily overpriced. We're looking for a move in here over the next probably 6 weeks, is the way this lays out, from 270 where it is now under the 200 level. That's the way we have it projected in there. That is Twilio, amazingly overpriced. This one makes absolutely no sense to me. It's in what we call the rising minor cycle right over here. Look at the beautiful cyclical harmonics in here as the stock fell over about 6 month or year period, from 170 down to about $22. And then it jumps all the way up here to 267. Why? I mean, you got upgrades in earnings. Hopefully they'll get up to only losing $3 a share next year. This is outrageously valued in here, and we're looking for a price of below 180 in this stock. And this is a little different pattern. This points towards the end of November in here. So might dance around here in a little bit, but this is just a sick level for this stock. Crazy pricing, makes no sense to me. And rounding out the six that I think have got a ton of risk right now is Wingstop. This has a PE of over 100 for a restaurant stock in a time when restaurants are getting clobbered. They're, maybe they have a good carry-out business, but their forward PE over 100. This is outrageous. We're looking for a decline down towards 120 here in the next month. We'll call it 4 to 6 weeks, along with what we're seeing in what we expect in the stock market. Here's your declining phase here, a very strong one right over here and here. So this is anomalous. It hits the target zone there and then only pulls back about 5 or 6 points on the downside. But this one right over here from 72 all the way down here to 56, so that lost 16 points right over there. You can see this one in the big crack. That fell from lost about 60% of its value. This one from 107 down to 71, so that was about 38% of its value. So we could see in here, all we're pointing to right now is losing 20% of its value in the next 4 to 6 weeks. That's all, right? That's almost a bullish case, if you ask me. Forward PE of 100, Wingstop, terrible valuations in here, and I think huge risk. So these stocks that I showed you, the 6 massively overpriced stocks ready for big corrections, remember, I can always be wrong, and we're wrong sometimes. But these are very, very high odds, and I look at high valuations and extreme overbought conditions. These are setups for some pretty big declines. So I wanted to share that with you so you could see. All right, so now we're going to get into our short-term view for the coming week, where we look at 5 different markets: light crude, the gold market, the dollar, the bond market, and the S&P 500. I always want to be accountable to what I say. We're about 70% this week of inaccuracy, of accuracy, and we were 90% 2 weeks in a row. So we've been really, really strong. This week we get the stock market wrong. We're not going to get any credit for that because the shape of the patterns is different than we had expected. Even though it stopped at the point we expected it to, the pattern's a little bit different. We're not going to give ourselves any credit for that, even though we do think that there was a setup to the downside in here, and all we've been doing is bouncing back and forth. We also get only about half credit on the dollar, because the dollar, while we expected it to go down, we also expected it to rebound. So we had a really good call on it 2 weeks ago, and this week, well, not as good. So now we're going to switch over to our daily charts. We're going to leave Wingstop and go to /CL for the light crude market. So we expected the light crude market to be moving down, and you can see in here it has been moving down. This is a very exceptionally narrow range that you see right in there. So I want to kind of blow it up for you to see, and what we're looking for is the next week to be on the downside. For the very near term, our target is 38.50 to that support level that we see right over here, 38.50, 38.30, and then get a rebound. But we think that rebound will fail, and then we're going to get into those bigger corrections. Note in here, see where this positive momentum came in? It was at 33. It drove it all the way up here with all of these buy signals on the bottom on the projection oscillator, giving you the really powerful conditions. You lost the upside momentum this week, actually today, and that is a sign of things changing in light crude. Some of the evidence, momentum weaker, intermediate patterns rolling over. There are demand worries with these very, very weak economies in depression, no matter what they tell you. This is a depression. And lower prices are likely in light crude based on what we see in here. So we're going to call the next week on the downside a test of 38.50. Gold market /GC really is a very, very strong action as it gets up to that 205 level that you can see there. Just going to tighten this up a little bit right there for you to see those patterns. So this is where the cycle bottomed right in here, and then the next big rally, momentum positive right over here. It turns positive at about 17.95. It rallied over $200 in that positive momentum. Buy signals coming right in here. You can learn about this by watching our video on Slim's favorite study pairs, the Slim Ribbon and the projection oscillator. The strong momentum still exists. It gets up to 2005. Our target at 1670 was 2000. So just extraordinary. We're now believing that we're in this little corrective period, that we could get a dip down in here in the gold market. So we're kind of likely to stall in here. Silver's looking like it's stalling. This would be a test here of about 935, 930, somewhere like that. And then back up over here to this 2000 area. Note we added an upper track in here because there is a minor 61.8% fib extension. The probability of getting over 205 is very high over here. So we added this as a pretty good likelihood up to 2045 here in this near term over the next few weeks. For the next week, we're going to call this dip in here that we're looking for, and then after that for a couple of weeks, more upside potential in there. So momentum still strong, as you can clearly see. Dip to 1935 makes sense as a buying opportunity. You can see the supports right in here. That's where our buy zone is going to be once we get sure of the anchor point up on top. And we'll here are some of the evidence is all time frames are positive. We have momentum in everything, though silver is stalling. We've upgraded the range now between 1935 and 2045 for coming weeks. So overall, still very, very nice patterns in the gold market. Next thing we'll look at is the dollar. Now we have a revised pattern here. Excuse me. So you'll note when we put in dotted lines that in there we have a revision. And these ghosted cycle brackets in the bottom are the old cycles that we had in here. We see a change as they have this long capitulation going on, as this negative momentum right in here really was spot on that you see right there as it keeps going down. So we're looking at these minor thirds right now. We've revised this wider dominant and these focus on the minor thirds that are pretty clear. We lost the real clear minor quarters. This low didn't line up, though this one did in this extended path. So the minor thirds are much clearer to us, and that has much more value. On top of that, what we're looking at right here is this bottoming pattern right there, which is after this big decline. This is called a bullish piercing pattern. It's made up of two bars. It's a 2-bar candlestick where you have this decline. It makes a lower low and then closes more than halfway up that body. That is a positive signal and the bottoming. We're going to look for the next 2 weeks for a rally in here in the dollar market. That aligns with what we believe to be a corrective process in gold and silver. Upside target is now lowered by a little bit. It would be at around 94.50. We were looking for more like about 95, but that's not likely. We're in this really negative momentum that you see, and we're going to expect this move up to 94.50 and then fail. Probably this 92.54 level is the worst that we're going to see for a while, and that is probably going to bring some choppiness here in that gold and silver market based on what we see. Major trend down. Some of the evidence says momentum down in all time frames. Bounces should be sold. The major currency pairs have signaled this for weeks, and we have been spot on that analysis. Please do watch Future Speak for the deep analysis of all of the major currency pairs that we do every single Wednesday. So that is a look at the dollar index. Next thing is the bond market. We'll look at the 30-year, the ZBs. The Fed has killed this market. There's basically no trading in there. Our objective was for the bond market to get up to about just under 184. We're still holding on to that in here, especially since we think the stock market is about to accelerate to the downside, and that probably will bring some bids in here. The upside objective is this resistance level right over there. That comes to 183.20. That's an intermediate resistance level that we're looking at. We still think you buy minor pullbacks in here and likely to continue to get upside movement. I want you to see the very clear minor thirds in here on these bigger cycles, and they give you the sense for how the timing works in here. So here is 1, 2, 3, 1, 2, and we're in the third rising phase. So what probably happens is you get a little bit more rally in here, and then you get a little correction, something like you see over here, but then moving up again up to that close to 184 level. So just some, we think, continued minor moves in here as the Fed has killed the bond market trading. I say that all the time. It's so annoying to me because I grew up trading bonds in the bond pit on the Board of Trade, along, of course, with my time on the CBOE and Chicago Merc. So that is annoying to me when you have a market that becomes untradeable like this. The 10 years are far worse, as there are simply no ranges in there whatsoever. So that is a look at the bond market, which we're going to just look for minor little dips, higher prices overall. Some of the evidence is all momentum is plus, and that is the reason we think it's going to continue going up. Note, for those of you that watch Future Speak or our big picture analysis, we have shown that we believe that the interest rate low or the bond market peak is not until September. So that aligns with the decline that we see coming in the stock market. So that's the first 4 items in our short-term view. Before I bring you the stock market, just one brief message in here. Our trials, we're in our final days right now. We're opening it up to all levels, 1, 2, 3, and 4. Depending on what your trading style is, what you need, what you want, you can learn about that. Go to askSlim.com to the front page, scroll down the memberships, and you really get a sense for what is going on and what we offer in all of those levels. For those of you that want the education, we have over 500 videos in our video library. That's a level 2. For those of you that are active traders in the indexes, our stock index reports are amazing, including the live stream. That's level 2. For those of you that want more, that see our Slimulator ranking system and the 84 best traded stocks and get our trading ideas, that's level 3. And for those of you that want our charts and to be able to ask me about analysis, that's level 4. So lots of very, very interesting things, and I don't know a way that you could get better education and analysis than that which our amazing team brings. We have trials for 1 or 3 months available. Write Matt at askSlim.com. He'll send you the trial links, and if you're serious, then he will give you a walkthrough even and you'll be able to see the content. Right, Matt at askSlim.com. That's MATT at askSlim.com. He will just ask him for the trial links, and he will send those to you, and you'll be very, very happy that you did. All right, so now let's get to the short-term view of the stock market, SPX. Last week, we talked about the next 3 weeks, and what we thought was the market would move down, have an attempted rally, and then move down very, very sharply. We had thought that the switch had been flipped and sellers were out there in the market. That changed this week when we got a load of the earnings from Apple and Amazon and Facebook, because those really affected the NASDAQ, which gave a lift to the market. So the patterns are a little bit different, and the same thing for Facebook and Apple as far as their patterns, which we have updated for our members. So if you want to see those updates in your level 3 or 4, you can get those on our site. The overall patterns in the stock market now, not a lot different than we were looking at. Still calling for the intermediate of this larger correction that we're looking for. So let's take a look here as we switch over to SPX, S&P 500. So here are those repeating cyclical patterns that we keep looking at, and this low right over here showed a breakdown in the NASDAQ. And then it came back up to test these highs, which is pretty unusual. You can see in here that you still have this upward momentum that began way, way back over here. That's where it started right there at 27.77. You had a 450-point rally on this positive momentum. Look at all the buy signals here. If you become a member, you'll learn about how to use this, and also on our 2-hour charts, which just give crazy good information. And now let's just look at these last 3 cycles right in here so you get a closer look. And you can see that this minor cycle was a little bit shorter than I expected it to be. We had people write us about that and say, could that have been it? And I didn't think so. I thought it would come down a little bit more and then rally and then start to move lower. But then you had this big earnings on Thursday, and that moved the market up, but you could see it pulled back pretty sharply in here as we had a big up day in the morning, and then it moved to the downside. Apple's still holding everything together right now, up 26 points on the day, and that has the NASDAQ to the plus side, while the S&P 500 is down about 0.4%, down about 14 points now. So we're looking for this next week to be on the downside. The downside targets that we see in here, best case is 31.85 to 31.60 over this next, we'll call it 4 to 6 trading sessions in here, and getting down there. You can see these support levels. The top of this, right around where the bottom of the slim ribbon is at around 32.03. We're looking for this 31.85 to 31.60 in this next 4 to 6 trading sessions. We think that it is a high probability that happens, and that this lift that the market got based on these earnings from these few stocks, well, we think that's going to go away, and you see it actually failing to hold that up today. So we'll look for this down week. Then if you look out for 3 weeks or so, you get some kind of a rebound here, and then the acceleration to the downside as the intermediate corrective patterns take hold and move down. We believe that this would be the final period in here of trying to the upside, but it would be from lower levels. So this is the way we're projecting it right in here. We had a higher track up in here, but it really told us that that wasn't happening. And you can see the thrashing that's been going on here in the market for 2 weeks, as it really cannot make any upside progress any longer. And now it looks like it's rejecting those key resistance levels right in there. This high level right there was around 32.74, I believe that was, 32.80, sorry. And it could not get through there, up there, and then today beginning to reverse again. Some of the evidence, all momentum still positive. We have this thrashing going on, but a very much narrowing of leadership that we see. everything in this thrashing and this stalling, all of that is in alignment with the effect of the longer-term downward turn we see. We don't really have a sign of it yet. This is anticipation by me as I anticipate the effects of the longer-term trends, looking at the highest probabilities. So that's what I see in here, but no sign yet. Momentum conditions all strong, cycle configurations all strong, and it's me telling you that I think something is out there because of my experience looking at the longer term patterns. So indicators positive, my attitude negative, looking at these longer term trends, and what I see is the effect of them starting to show right in here at that level. So I wanted to explain that pretty good to you. Momentum strong in all time frames. The market has to prove it's weakening, and that means the selling that I expect in the next 4 to 6 days should have some severity to it, so we get a sense for moving away on the downside from that resistance level. That is it. Showed you everything I have for you today. I hope you found the information extremely valuable. Remember that all we want to do is help you to be better traders, the best traders you can be. Your success is our success. Please go to askSlim.com, look at everything I told you about. I want you to be so careful. It is so crazy out there. And we're always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been